You're listening to the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions at theoptionsinsider.com.
This is the Options Industry Council's Wide World of Options. Before we start today's show, investors should know that options involve risk and are not suitable for all investors. You should not enter into an options transaction until you have read and understood the risk disclosure document, characteristics and risks of standardized options. This brochure is available by visiting www.optionseducation.org or by calling 1-888-OPTIONS. OIC makes no recommendation with respect to any financial firm. OIC does not make any warranty as to the accuracy, usefulness, timeliness, or the continued availability or existence of information created or maintained by others. Multiple leg strategies involve multiple commission charges. Opinions and strategies expressed by others are not necessarily those of OIC, nor does OIC endorse, warrant, or guarantee products, services, or information described or offered by such firms. Commissions, fees, margins, interest, and taxes have not been included in any of the examples used in this show. These costs impact the outcome of all stock and options transactions. Consult your tax advisor about any potential consequences. None of the information presented in this show should be construed as a recommendation to buy or sell securities or to provide investment advice. Welcome to the Options Industry Council's Wide World of Options. OIC was created in 1992 to educate investors and their financial advisors about the benefits and risks of exchange-traded equity options. And the Wide World of Options radio show is one of the ways the message is spread. OIC also offers a variety of other resources to those interested in learning more about options, including webinars, podcasts, and live events. For more information, check out www.optionseducation.org. Now, here's your host, OIC's Director of Retail Education, Ed Modla. It's time to break down the latest option strategies. That means it's time for Strategy Spotlight.
Joining us on today's Strategy Spotlight is Dan Keegan, founder of OptionThinker.com. Dan has a tremendous amount of experience in the industry and is a colleague of mine. Dan, before we get started with our strategy, can you tell us about your experience, background in the industry, how you got started with options, and what you're up to today?
Okay, sure, I can do that. I've been involved for decades in trading options one way or another. I started out as a floor rat almost 40 years ago as a runner for a company called A.G. Becker, and just did a little bit of everything, was phone clerk, floor broker, all that. And after about 5 years of that, Steve Fawcett, the guy who flew around in a balloon with Richard Branson, backed me with money on a 3-year deal as a trader. And after that, I was able to go on my own. So I've been a market maker for close to 20 years on the CBOE and a little bit on the Board of Trade as well. So, and about 10 years ago, started the Chicago School of Trading to individually teach people how to trade options. That was the Chicago School of Trading. And then about 3 years ago, I started OptionThinker.com, which we're doing the same thing there, just teaching people one-on-one how to trade options. And if you want to reach me after this or for any other reason, you can reach me at Dan@OptionThinker.com. I'd be happy to answer any of the questions you happen to have for me. So that's pretty much my story. Still do trading and teaching people how to trade. So options has pretty much consumed my entire adult life.
Well, that's great. That's a very lengthy, storied career. I know you're doing wonderful things at Option Thinker. So thank you for making the time to share your expertise with us today. I know you wanted to get into a very unique and interesting trade involving straddles. I think first, let's start with the more basic level so our listeners can get a little foundation before we get to your trade. Let's just go with the long straddle to start things off. Can you define for us what the long straddle is and how it's put together?
Yeah, so long straddle, Ed, is when you buy a call and a put of the same strike price, and that strike price is usually going to be the closest at the money strike price. Okay, so that makes sense. I could give you an example. The XYZ stock trading at 200. Okay, the calls are trading at 5.60, and the puts are trading at 5.60. Okay, so if you're really bullish and you think the call, you just buy a call, your upside break-even point would be 205.60. And if you're really bearish, your downside break-even point would be 194.40. Okay. Okay. So, but excuse me, that's if you bought a put by yourself. Your downside break-even would be 194.40. Okay. So if you're bearish, you buy a put for 560. If you're bullish, you buy a call for 560. If you're not really sure what's going to happen in the future, which after decades of doing this, I'm still not very good at seeing what happens in the future. You could buy them both together. Yeah, absolutely. He was a market maker for quite a while as well. You could buy this for 11.20. Okay, the 560 and 560 is 11.20. So your upside break-even point then is 211.20. Okay, and your downside break-even point is 188.40. And
okay, I think I got that. So if you had bought the options outright, what you said initially, your break-even points are 560 on either side. But if you're buying them together in the straddle, then you're going 11.20 outside your strike price.
Right. So it'd be 188.80, and it'd be 211.20. So, okay. Yeah. Okay. So you're giving something up, but you're getting something in return. What you're getting in return is, if it makes a move in either direction, you could benefit from that. Now, there's ways. So if it's outside of that range, you're a winner. If you're within that range, you're a loser. Now, there's actually ways of making yourself still a winner within that range, but that's a topic for another day. So,
right. Okay.
So basically, you're looking at this as something you want to move. Okay. Because if it just sits there, what happens to every option is a wasting asset, right? So you're not the beneficiary of that. That's detrimental to you. So everything trading options, it's leverage versus the wasting away of the option. Okay, the option gives you the ability to have leverage, so you could get it in either direction in this case. Okay, but you're doubling up your wasting away too. So the graph kind of looks, anytime when you're long options, when you're long both a straddle like this, it's a smile graph. Okay, initially starts out as a smile, and then it turns into a V. Okay, like the Winston Churchill V for victory sign. Except if you're at the bottom of the V at expiration, which is what the V with the smile turns into a V, you wouldn't be putting a victory sign up. You'd be putting a big loser sign, okay? Because you need movement away from that strike price. The absolute death spiral for a long straddle is a strike price. So
right, makes sense. We're long a call, long a put. We need a movement in either direction of a significant magnitude. And our risk is if the stock doesn't go anywhere. Both of those, as you said, are decaying assets. So we know we're buying a call and put at the same strike. What about the choice of an expiration date? What kind of factors are at play when we're using a long straddle and choosing how long we want to hold this position?
Okay, obviously the further out you go, the more time value you're going to have. All right, so it's going to be, eventually the risk is greater than if you did it, like, let's say you do it 4 weeks out versus a week out. If you do it a week out, you're going to have a much smaller price that you're going to be able to buy it for, but you have less time for it to make a movement. So it's a double-edged sword. It's kind of, there's no right answer to that. It's what is your tolerance? The other thing is too, if it's nearby, it might be expensive, but it's moving like crazy, then it might be worth it, okay? Because it should be outside of that range. And if it's 4 weeks out and it's moving like crazy, you're going to have to pay more than you normally do, because if the market's dead for, months at a time, the price for a long straddle is going to be really cheap, okay? So, because nothing's going on. It's not moving. So if you buy, like, let's say the 4-week straddle, you're buying it at a high level if the market's moving around a lot. Okay. So during that time, if all of a sudden the music stops, okay, it's like musical chairs. You go to sit down, you can't sit down. All right. All that premium you have gets sucked out right away before expiration. Not all of it, but a good chunk of it. So that's the difference.
Yeah, as is often the case when we're putting together strategies, each situation is a little bit different, and the investor has to analyze their market outlook, what they're trying to accomplish, and once they answer those questions first, as you've explained, that leads you to an expiration date. Now, Dan, I do want to ask you, every time we do any options trade at all, we have to be aware of our exposures. You outlined the market direction we're looking for and where the risks are, but Greeks always play a role when we're trading options. Can you just outline for us, when we're long a straddle, what are those Greek exposures that we have with the position?
Okay. Well, the one exposure is delta, because delta shows you what, like 50 deltas on a call is equal to 50 shares of stock that you're long. Okay. But if you're buying a put at that same strike price, you have a negative 50 delta put. So that's equal to short 50 shares of stock. So you put them together and you have 0 delta. So in terms of market direction, you're not going to be hurt necessarily either way. Okay. The next one to look at is gamma. Okay. So you would gamma show is a derivative of delta. So let's say it's a 3 gamma. Okay. And the stock moves up $1, then the new delta is 53 for the call. If it drops, it's 47. All right. And the theta is $10 a share, or $10 for each option you have. Okay. That it declines. It's 10 cents, 100 shares per option. So it's $10 is for each option you own. The very next day, all things being equal, the premium will be $10 cheaper, or 10 cents cheaper. Okay. $10 is an absolute number, but 10 cents when looking at it from the theta. All right. And then the biggest one maybe in doing a straddle, especially if you're doing it a month out versus a week out, is Vega. Because Vega measures the storehouse. Vega is like a storehouse of time value. Okay. So the further you are out on the expiration cycle, the bigger storehouse of time value you have. And like I said before, if all of a sudden the desire for time value falls and you're long that straddle, you get hit right away. So basically, those are the 4 elements that you really need to look at when managing your long straddle. So the danger is the theta, obviously, that's wasting away every day, and the Vega, where all of a sudden you can have the time value in your options ripped out faster than the normal daily decay.
Got it. But, that's a good framework. As you said, that the delta is neutralized, but the gamma, theta, and Vega certainly play roles with this position with 2 long options. Now let's shift to the other side rather quickly, the short straddle. Can you walk us through that? And then is it safe to say, with respect to these same questions on motivation, market outlook, Greek exposures and such, is it just going to be the exact opposite of what we just went through? Can you talk to us a little bit about what the short straddle looks like?
Yeah, it basically is the flip side of it. Okay, so the graph looks like a frown instead of a smile, and the expiration graph looks like a teepee. Every option, the time value is gone at expiration, right? So if you short that 200 straddle, okay, and it's right at 200, both of them are going to be worthless at expiration. So that's the thing. And the other thing is you have theta working on your side. Okay, that's your ally instead of your enemy. Because that daily decay every day, it's not like you get handed a check at expiration, like, yeah, they went out worthless. Every day it decays, that's positive to your account, and you can close the trade out at any point. So that's the good thing. The bad thing is the gamma, as it moves up, okay, you become more negative deltas. As it moves down, you become more positive deltas. That's the exact opposite of the way you want to trade, right? Everybody wants to be long on the way up and short on the way down. This is the opposite. And the other good part of this is the Vega okay? If there's a drop in implied volatility, then you're the beneficiary of that, okay? Because you get paid right away instead of over time. Now, that's why when you're shorting a straddle, you generally don't want to do it in a real low volatility time because the premiums are going to be much lower, okay? And you're going to be entering with a negative vega position, okay? And all of a sudden, it's demand for these options. You're kind of screwed at that point. So those are the pluses and minuses. So they really are just mirror images of each other, the long and short straddle. So
right, as expected, reciprocals of each other. Short straddle being short call, short put with the exact opposite exposures. Now, many investors who've spent some time in the option space may have traded either one of these positions, the long or short straddle, or at least have had some exposure to them from an educational perspective. I know you wanted to talk about something a little more unique than that and take it to another level using both long and short straddles in a position and possibly across different expiration dates. Dan, what kind of trade did you have in mind that you wanted to share with us?
Okay, this is one where we're going to be shorting the May 17th straddle for XYZ, and we're going to go long the June 7th straddle. Okay, so they're going to be 3 weeks apart. Okay, so the vega, it's going to be definitely a positive vega position. All right, and here's how we're going to do it. We're going to sell 10 of the May 17th straddles that have a -5 gamma, a +22 theta, and a -10 vega, okay, for their 10 lot, okay? And then this is going to be a 20 lot that we're going to be long out June 7th, okay? So why would we be buying 20 and selling 10? Because theta is, options don't decay on a continuous basis. It's an exponential decay. In other words, the closer you get to expiration, the quicker it decays. All right, so you put an ice cube out on the counter, and you walk out the door, you come back, and you see it was sweating on the way back. When you come back, it's practically melted. Now, if you had a big chunk of ice on that counter, you walked away, you could walk away for twice the amount of time. You come back, you could barely see that. So that's the way to look at options decay. Look at it in an ice cube for near term, iceberg for further out. Okay. So when we're doing this, we're buying the June 7th. The vega is 20. Okay. So and we're doing it twice as much. So you're going to have, for your further out options, you're going to have +120 gamma because you're lying that. You get a -400 theta and +800 vega. So your real danger in this position is if all of a sudden there's a big volatility takes a turn and they go at it. Well, where you're in charge is the positive theta you get from your short straddle is 440, and your negative theta from your long straddle is 400. And as the week goes by, that will even widen out more. Okay, because theta, that week of expiration, increases dramatically each day, as long as it's within that same strike price range. So this gives you kind of a week's time to get through here. And since you have more options that you're long than you're short, if it makes a big move, you're a winner that way as well. Obviously, if you're just naked long the straddle without being shorted, you would have made more money than you did by shorting the straddle. But this gives you some time to play with because the daily decay is not burning you as badly. Your real risk is the vega, that storehouse of time value. And this graph, unlike the TP and the other, it's kind of like a lazy W. Okay, so if it closes right at the strike price for this week, you've hit a triple, okay, because you collected that decay. Your decay that you collect is going to be more that you burn off. So then you have 2 weeks left, and you can maybe sell another time spot, or you could do vertical, whatever. But this way, it gives you a little play during that time. It's just a little different way of looking at the straddles. Mm-hmm.
For sure, yes. It's really interesting to hear you walk through that. And just to summarize that, we're selling a short straddle, selling a straddle near term, and going out, as you described, 3 weeks and buying a straddle, but twice as many in quantity. When you put those two things together, as I heard you describe that, it really changes the dynamics, the risk profile, and the exposures you described this loose W-shaped curve. As I'm thinking through that, am I correct, Dan? You said if the stock doesn't move anywhere, that the near-term straddle will decay faster and in greater quantity than the long-term, even though we have twice as many long straddles. Is that correct?
That's correct. You got the iceberg that doesn't melt as quickly against the ice cube that's melting rapidly. So.
Gotcha. Okay. And then with mild moves on either side of that, the sensitivity of those near-term options will incur losses at a greater extent. Now, with respect to the long units, it's very interesting how you said those big moves in either direction, which really form that W shape. Since for long units, large moves either up or down would start to work in our favor since we're net long units. Considering that, if we start to see losses and the position isn't going well, do you consider it necessary to manage out of this position, or do you consider it a trade that has built-in protections?
I don't think there's any trade that has total built-in protections, unless you're talking about a box or a reversal, some of those interest rate type plays. Yes, you do need to manage out of it, because if it lazily moves up, initially it should be okay for you, but over time it's going to hurt you, okay, because that you've got the time value spread, which is a part of that, is working against you. Okay, so yeah, you would be looking. But what you would do is you would manage your deltas. Okay, so if your deltas are going in a certain direction, over time the deltas themselves change, especially during expiration week. So something out of the money tends to just lose all of its value. Something in the money gets a much larger delta. So you could do that, and also if the biggest danger I said was the Vega. Okay, if all of a sudden the panic in a market stops, if you happen to be putting this on when there's a high degree of implied volatility, then you look to be selling something further out that could help you with a Vega, so that the immediate decline in the time value won't hurt you as badly. So
that's the last thing I wanted to mention about this strategy and ask you about, Dan. You've outlined the Greek exposures very nicely. As we see market forces change, this would include stock price movements or the passage of time, maybe changes in implied volatility. What do we need to look out for as far as our Greek position and exposures changing as those variables change with the open market?
You talk, for this example, yeah. I mean, it's just if all of a sudden you start to see a decline in implied volatility, that 3 weeks out or something, you want that to be the first thing you want to look at. It's like the tulips bulb craze when the guy found out he went to sell the tulips at this place and nobody bid on him. He got on his horse, went to the next town in time to sell it before they found out the tulips aren't the craze anymore. So you just have to be very wary of, you really have to track the implied volatility on all the options and be ready to spring into action if something like that happens. So
yeah, it's a common theme to keep track of your trades. Options investors are fully aware that, generally speaking, you have to watch your trades every day. It's part of what makes this industry and using options so interesting. Common theme that comes up when we talk about strategies is just how versatile the options product is. I think your example here, Dan, was a great showcase of how you can take two rather simple to understand strategies and put them together, combine them in such a way using different expiration dates and different quantities to completely change your exposures and your market outlook. So thank you for that strategy. Did you have any final thoughts you wanted to wrap up with?
Well, no, I just like you said, Ed, I think knowing how to manage the position is probably 10 times as valuable, at least 10 times as valuable as having the perfect trade to put on. Because people are always waiting, I want the perfect trade to put on. Well, it doesn't exist. You don't want to put on something stupid, but you really have to know how to manage your positions.
Right. Managing positions is absolutely crucial. So thanks again, Dan, for your time. For our listeners, can you just repeat, as you did in the beginning, how can our listeners get a hold of you if they want to do so?
Yes, if you want to email me, I'm Dan at optionthinker.com. That's singular option. It's all one word, Dan@optionthinker.com.
Well, that's wonderful, Dan. We appreciate your expertise and taking the time out to share that with us. And thank you for joining us on Strategy Spotlight.
Ready for a little nostalgia? It's time to take a look back.
In today's Looking Back, I want to summarize annual options volume from the decade that included 2008 to 2018. First of all, it'll be a little bit of a disservice to start at 2008 as the industry experienced explosive growth just prior to that. Changes in the industry that included electronic trading versus open outcry, decimalization versus fractions, and multiple listings across exchanges really helped the industry explode as the century turned into 2000 and 2001. Also, education and awareness for investors and taking control of their own money led to massive growth in the options industry. 2008 and 2009, of course, were very volatile years. And compared to 2007, the industry saw about a 25% increase in options volume. But really, that was just an acceleration of the growth that we had already seen. There was a spike in 2011. For the first time, the industry traded over 4 billion contracts. I'll spend just a little bit of time on 2011. We saw implied volatility levels heightened throughout the entire year. That was largely due to several factors. The European sovereign debt crisis was front page news headlines throughout the year, particularly in countries like Spain and Portugal. The U.S. also saw its 7th largest bankruptcy in U.S. corporate history, and that is in the form of MF Global, who announced their bankruptcy in late 2011, largely due to their exposure to European sovereign debt. It was Black Monday, August 8th, 2011, where the markets dropped over 5%. This followed the news that came out the previous Friday that Standard & Poor's downgraded U.S. sovereign debt. That was the first time in history that the U.S. was downgraded. So 2011 had a lot of events that triggered volatility, and options volume spiked up over 4 billion contracts. Subsequent to that year, we had low volatility, and partly due to aggressive action by governments that started back in 08-09 with respect to monetary policy, the market saw bullish activity and rallies, very short-term pullbacks, sell-offs that couldn't last, and continued low volatility environments. Despite all of that, the industry maintained volume right around 4 billion contracts. That showed tremendous resilience and strength for the options industry. So in an environment where you would expect to see decreased volatility, we did not see that. That took us up to 2018, where we also saw increased volatility. Throughout the year, we saw volatility begin in February, reaching levels far above their long-term average. And 2018 ended up being a record-setting year. For the first time ever, we traded over 5 billion contracts. Throughout this decade, we saw the industry grow, and certain political, economic, and macroeconomic factors play a role every single day. We're expecting this industry to maintain its strength and its growth. And that's today's Looking Back.
Next, let's upgrade your options toolbox with cutting-edge trading platforms, devices, and information. Let's talk about tools, resources, and good reads.
For today's tools, resources, and good reads, I'm going to start with a website for a tool. This is Financial Visualizations, which can be found at finviz.com. That's FINVIZ.com. Here you can screen the market using certain criteria for stocks you may be interested in trading in. Some of the filters you can use are market capitalization, average volume, and dividend yield. This can help you more clearly identify stocks that you might be interested in trading. Once a symbol is selected, whether found through criteria or something you are already interested in trading, you can analyze a price chart. Certain studies will be available, such as 20, 50, and 200-day simple moving averages, also trend lines, and various time intervals, such as weeklies, monthlies, and dailies. There's also a plethora of fundamental information available, such as current and forward PE ratios, price to book, price to sales, gross and profit margin, earnings dates, and many others. Also, if you're interested in what the street thinks, this website will provide recent upgrades and downgrades. It's a very nice tool to have as you're analyzing the market, selecting stocks you want to trade, and then fine-tuning those trades into specific action. Once again, that's financial visualizations at finviz.com. For our resource today, I'm going to take us back to the OIC website, specifically the strategy section, which is section 8. The website is optionseducation.org, and if you open the menu, you can find section 8 there underneath. This section begins with guidelines on how to choose the right strategy for you and also offers key insight on how to keep things simple and stay focused on the trade you might be interested in. More importantly, it offers a breakdown of strategies by category. These categories include bullish, bearish, and neutral market outlooks, in addition to the motivation of hedging or protecting stock positions. If you trade implied volatility, you can also identify what strategies might capitalize on implied vol moving higher and others that would capitalize on implied vol moving lower. Once again, that's section 8 at the Options Industry Council website, which is optionseducation.org. And for a good read today, I've selected Understanding Options by Michael Sincere. This is a basic level book geared towards those who are trying to build a foundation in their options education, to continue their journey, and maybe fill in some blanks on concepts they might not be too familiar with. This book will describe, first of all, what options are, what the pros and cons are of using options, the different motivations of leverage, generating income, or protecting our portfolio, and we'll get into some spreads too, credit, debit spreads, and collars. It's a nice reference to keep on your trading desk, and that's Understanding Options by Michael Sincere. And that's today's tools, resources, and good reads.
We love connecting with our listeners. With that in mind, let's take a moment to answer a few questions on OIC's Wide World of Options Q&A segment.
As always, we're going to connect with our listeners. We take a few questions on every show from our listeners, so keep those questions coming as we certainly value your input. First question comes from Mike G., who asks, does it ever make sense to exercise an option that still has considerable extrinsic value? First of all, Mike, the word considerable is subjective, so it's very difficult to provide a confirmed yes or no answer. So let's just look at exercising in general. Of course, at expiration, there is no time value, which means there's no extrinsic value, and the decision to exercise is based solely on whether or not the option is in the money. That's pretty clear. Prior to expiration, there's a bit more analysis that needs to be done, and that scrutiny is different for calls and puts. First, on the call side, upcoming dividends are usually the reason why an investor might decide to exercise early. Specifically, if the option is in the money and the upcoming dividend amount is greater than the extrinsic value, it would be in the financial best interest of a call holder to exercise early. In the case of puts, cost to carry plays a big role. Think about what happens when a put holder exercises an option. They will be paid in cash the aggregate strike price amount. If the cost of carry on that amount is greater than the extrinsic value, then it would be in their best interest to exercise the option early. In other words, if they can exercise their put option and earn more in risk-free interest than they give up in an extrinsic value, then they should exercise early. So different analysis for calls and puts, but please keep in mind, the decision to exercise is always entirely up to the option holder. They can exercise or choose not to exercise at their discretion for any reason they want. Thanks for the question, Mike. And number 2 comes from Dennis, who asks, there are some options with large bid-ask spreads. What can I do to get closer to the ask if I'm the seller or closer to the bid if I'm a buyer? It's a very common question for investors who are trying to execute orders and can't quite get the prices they're looking for. And Dennis, there's no magic formula for this. Trying to get a better price or working for a better price is an art form. I'm going to take a step back from a high level and say that exchanges are constantly trying to offer options on products that have interest and will trade, but inevitably there'll be different categories of stocks. Of course, some stocks won't have options at all. Others will have options that trade infrequently and have large spreads, and others will trade frequently with very tight, workable spreads. The industry will likely have those categories moving forward, and it's up to the investor to navigate and investigate what they want to trade and choose how best to participate in the market. It's certainly possible that spreads are wide enough that you don't want to trade options, but that's an investigation you have to do. Could be to look at the depth of the market. Most brokerage platforms will allow you to see the bid size and the ask size, and possibly the bids and offers with their sizes beyond the best bid and offer. That can let you see the depth of the market book and how much size is on either side. Ultimately, it's going to be limit orders that you're going to have to use to execute better prices, and in conjunction with your familiarity with the symbol, watching the options trade and having a comfort level with that particular underlying, and possibly analyzing the depth of the order book, you might be able to make a better decision on what price to use as you're placing your limit order and adjusting the price. Good questions from Mike and Dennis. Thank you very much for sending them. I encourage all of our listeners to keep those questions coming in, and thank you for listening.
You've been listening to the Options Industry Council's Wide World of Options. If you have any questions about anything you've heard on today's show, email Ed Modla at options@theocc.com or visit www.optionseducation.org and chat with Investor Services. Interested in connecting with OIC on social media? Like the OIC page on Facebook. Follow them on Twitter at options_edu and Instagram at optionseducation. And follow their page on LinkedIn. Thanks for listening, and be sure to tune in to the next episode of Wide World of Options.
The preceding program was a production of the Options Insider Radio Network. For more quality options programs, visit www.theoptionsinsider.com or search for Options Insider Radio Network in your podcast provider of choice. Listeners can also access all of our programming through our mobile app, available in iTunes and on Google Play. Don't forget to follow along with your favorite programs and submit your own questions for the hosts at twitter.com/options, facebook.com/theoptionsinsider, or via questions@theoptionsinsider.com.